Hey, what's up, guys? Shravan Venkatraman here. In this Zen and Alpha podcast episode, we are talking to Kora Reddy. He's a fund manager at a US based hedge fund and he's a quantitative trader. His fund trades in the international equities and options markets, and he's also founded a trading analytics website called Past Stat. And he's written a couple of books on quantitative trading strategies for S&P 500 and Nifty 50, which is the benchmark index for Indian equities. In this conversation, we go over several quantitative trading related topics, including strategy creation, filtering out strategies based on market conditions, intraday trading, and much more. Be ready for some popular beliefs to be challenged, though, because it's been an interesting conversation, and even some of the insights that were discussed actually kind of um put me in a different perspective with respect to some beliefs that I already had. So, this will be an interesting conversation to listen to. I have to confess that there are some audio quality issues here and there, but overall, you'll be able to understand what we're talking about based on the context. The conversation takes a little while to get going, though, the first 8 to 10 minutes. But the last 30-40 minutes is brilliant, filled with a lot of wisdom nuggets that you can take away and actionably implement in your trading process. So, without further ado, let's get to the conversation. I was actually reading your book last week and I was curious actually. How did your interest in financial markets start? Because you were an EC student at NIT, right? And thereafter you worked as a software engineer after graduation. So, exactly where did the path diverge and you turn towards trading? Can you provide a backstory about that?
Mostly like my interest is mostly into the little bit of numbers like math or statistics. So that's the reason I'm a little attracted towards these numbers and probabilities or whatever you call. So
Did you get started with financial markets and technical analysis while you were at your workplace, or were you actively pursuing it well before that also?
see, I was never a fan of technical analysis or anything. So my entry was mostly, I think I would say it's a lucky start or whatever because I had a experience in this is like way back in 2000 or 99. So I
Okay.
had a experience in there's some distributed computing technology called Corba in those days, right? So and one of the hedge fund wanted to do some software development in that work.
Hmm.
And it's mostly back office or operational work, and that's my accidental entry. But I was not doing any trading or anything like that in the
Okay.
front office, what they call that's the terminology. And just because of that, I started doing on my own analysis because you get exposed to like how do they do the systematic trading or whatever.
Okay.
And from 2007 or 2009, that's when again I got back into like a job approach or whatever. So from 2012 onwards, yeah, I work in basically a fund kind of stuff. So where I build trading models and then we also manage the money. Like as you progress,
Correct.
you become fully manager kind of stuff. So
How did you transition from being a software engineer to a fund manager? Did you have to go through any hurdles compliance wise or with respect to any regulatory setups?
I mean, if you have to do on your own, you have to go through a lot of hurdles. But if what you call as a have a some background or some knowledge that you can show it to the funds, then that would be the shorter way.
Okay. So basically, this PastStat is a website that you started back in 2012, right?
That was like my because as I said, like I'm a software guy as well, right? So that's like my entrepreneurial activity, of course, which didn't take off because there was a competitor to that website called Insure. It is sold to S&P Global for about 600 million. So that was my dream too, but it didn't take. Yeah, so yeah, so the past is basically so it is like from my trading experience or whatever. So we wanted to translate that into an analytic platform or a tool or something like that for the end user side, whoever is into the quantitative stuff, so they could use that platform, and that was our idea. But somewhere we missed the track and we couldn't monetize it properly. Yeah.
Got it. So the work that you do right now with respect to your fund management is related to this website called Options IQ, right?
No, no, that's nothing to do. So the fund that I do is it's a little confidential and off. Nifty.in is just something, because right now I think the Indian market is also looking for some sort of analytical tools or whatever, which was not the case when we started this Postat in 2012. And so this is the completely different businesses. Fund that I work is basically a US based firm. It's something called Stingray Capital, and we trade across the globe, basically the US listed futures or whatever on the Globex trading platform, right? Starting from our S&P futures.
Okay.
And in the Indian market, we prefer trading options because that's where the liquidity and depth is, especially the Nifty and Bank Nifty options.
You were trading predominantly Bank Nifty in the Indian market, right?
And Nifty as well, yeah, the Nifty options.
Okay, is this because liquidity wise, Bank Nifty is the most traded instrument in Asia?
In the whole world, right now it has overtaken, especially after 2019 numbers.
Okay.
It is the largest traded contract. Earlier, it was a tie between Eurodollar and then this Chinese iron future or whatever we call them. And then Bank Nifty is the most liquid contract. So that's one of the reasons we trade.
Okay. What kind of trading do you do with respect to Nifty and Bank Nifty in the Indian market?
We trade. Okay, so I mean, it doesn't really matter. Like whatever the instrument that we select, we trade on various time frames. So the time frames could be ranging from a lower time frame bar, like 30-minute or whatever, and then or a daily bar or in a weekly bar. So most of the times our holding period is anywhere between 1 to 5 days. That's the maximum, especially in a short-term trading strategies or whatever. And we also build a long-term portfolio, and that is just for indexing purposes, because the whole idea is it's not that your trading strategy, whatever you design, is going to perform well into the future itself. So it might break down, or it may continue to perform, or it may continue to perform as you expected, which nobody knows in advance. So that's one of the reasons we built a little long-term indexing portfolio, and that is basically for you to guard against your own trading strategy failure, which might happen in future.
That's interesting. But how do you recognize that a particular strategy you're trading is no longer working or is no longer performing as expected?
So you have you have a, like let's say a few
Okay.
trading strategies, like trading strategy one and trading strategy two, and whatever, like, so the trading strategy in the past, if over 100 trades the expectation is, like, let's say 20 points in Bank Nifty or about 5 points in S&P futures. Now started trading and you did like about 50 trades into the future, and then your expectation was 5 points. So it's okay if you make like 4 or 6 points, but if you're just making like 2 points, your profit factor or your overall equity curve would have already worsened. My another point is it's very easy to develop trading strategies, uh, because I mean, it's just like you spend like a couple of days, you can pick up some ideas and then build your own trading strategies. Yeah, but killing ruthlessly, avoiding or like the trading strategies is what you should find a way to do it. I mean, the way to do it is, yeah, I mean, like your expectancy, whatever is in the past, if it is not matching, again, it's not a simple answer because nobody has an answer for that particular question when you want to stop a trading strategy. So, but basically, if you look at your own parameter criteria, like you selected a system, at least should have a profit factor of 2. Now, after 50 trades, it has fallen to 1.5 or 1.8. So that it doesn't meet your own criteria now. So you stop it. Or let's say the another way to stop it is, okay, you had a maximum drawdown expectation of 15% or 10%, whatever that system in the historical. Now into the future, it's already experiencing a drawdown of 15% or 20%. So yeah, I mean, dump that system and look for some other system. So
Okay, you must have used several strategies so far in the market. How frequently have you had to retire strategies? I mean, is it getting very competitive to find strategies that work in the current market, or is it still relatively easier to find strategies that have an edge?
We just give them one cycle. The cycle is, I mean, you could take any, I mean, basically the whole idea is market moves in, it doesn't move in one direction all the time, right? So it goes up and down.
Okay.
So your cycle could be, I mean, at a simplistic level, let's say, uh, you take simple moving averages like 20-day moving average cycle. So today now, let's say you crossed about 20-day moving average. So it goes up, and then starts falling down. And then again, it completes that cycle, right? Like a couple of moving average crossovers in 20 days. Or any cycle like that. Or let's say if you take 20-day high or 20-day lows, something like once the market starts hitting 20-day high, it keeps in a few more 20-day high. I mean, how many more? Nobody knows. But at least it keeps getting a few 20-day highs and vice versa also. So now this whole 20-day high and 20-day low, so it's like one cycle completion. It could take like 3 months or it could take 6 months or whatever. So preferably your trading strategy should have gone through in cycle like that you define. It could be a 20-day moving average, it could be a series of 20-day highs, 20-day lows, things, or maybe like a say starting point of 10,000 if it started, and then it would have experienced like a 10% up and 10% down or something like that. So once you complete that cycle, then you evaluate your pattern. So like what are they performing like same as before this cycle or not. So your review process, yeah, it's not a time. You could also do a time bound like once in 3 months you keep reviewing, but the whole disadvantage is um, yeah, sometimes uh, just like Nifty or S&P keeps running in one direction. So if you do a time bound, you may not be giving justice to do like an up cycle or down cycle or whatever you could call.
Makes sense. Uh, by the way, one of the things that I read in your book was that you do not use volume as part of your trading strategies. Is there a specific reason why you do not use volume at all and why you don't take volume into account?
I think that the context was different uh, where I've written in that book. I don't really remember that context. Yeah, but it's you use volume or you doesn't use volume, but yeah, you might want to incorporate volume as well. So
Okay, I was particularly fascinated by the sheer number of strategies in your book. How do you come up with these strategies though? A lot of them were price based. As you mentioned, the strategy now where when an instrument hits the 20-day moving average and crosses the 20-day highs, the instrument hits more highs in the market, right? How do you come up with such strategies? Is it purely by market observation, just by observing the market every day, or do you have a systematic approach to that?
there is enough of literature on the web which you can pick it up, right? So it's not like so the whole thing is yeah, you just search what is there is this website called Quantocracy or SSRN. So Quantocracy is basically it's a RSS reader. So it picks up from uh, 50 or 100 blocks, various blocks. So you just go and read. Once you read, they basically make statements, right? So any of these quantitative blocks, okay, price is at 20-day high or price is above 20-day moving average, and today market went down, market went up by 1% or 1% down, things like that. So now once you read that, then it's all being creative. Like okay, can I tweak this particular strategy which I read somewhere and keep testing? Yeah, so that's how you would have said like 20-day moving average. Now instead of 20-day moving average, you can change it to 50-day moving average or 100-day moving average. And then some guy would have said like a price is up by 1% today. So now, yeah, you can also do like price down by 1% or price up by 2%. I mean, like once you have an idea from somewhere you read, it's all like tweaking that in your own creative way. So that's how testing. And then if something comes interesting to you, yeah, so that becomes your at least you can put in a paper trading mode. I mean, before you deploy it.
This is quite interesting. A couple of Twitter followers also had asked a question along the same lines of the idea you suggested here. Like when you come up
Mm.
with ideas like these, how do you avoid curve fitting? We usually backtest ideas, right? But when you suggest, say, instead of a 1% up or 1% down days, try switching it up and test for 2% up or 2% down days or something like that. When you keep modifying the basic strategy by changing or adding parameters, how do you avoid curve fitting while backtesting?
So this whole curve fitting is basically the what you call so your strategy basically is nothing but a bunch of lines of code. It is something like today close is greater than yesterday's close. So that is one line, and then you put something else like today price is greater than some moving average, like 20-day moving average, and then you keep putting lots of funds. That becomes a curve fitting. So where it is a curve fitting, yeah, my simple thumb rule would be your code shouldn't be more than three or four. I won't say even four lines, but yeah, I would say like 3 lines. And beyond 3 lines, you are entering to curve fitting mode. Or just take for an example something like I don't remember, but I think whatever I remember, I'll tell you. So let's say you tested something called Bank Nifty closes above upper Bollinger Band,
Okay.
right? Most of the times when it is above upper Bollinger Band, it might be hitting a 20-day high as well. So let's say your upper Bollinger Band close above in the last 4 years, there were like 50 trades. And it's a good trade in the sense like 50 trades, let's say an example of 35 winning trades. So it meets all your criteria, right? So that's a single line of code. Now, you also write a second line of code, which is like Bank Nifty is closing at 20-day high, right? So you also get, let's say 55 trades. Now there is this 50 and 55 trades, right? So now, because you are observing, there is like interlap of 5 trades, there is a interlap of some trades, and then you remove them or you add them, this, that. Then you come up with a rule like Bank Nifty above 20-day moving. So Bank Nifty hitting 20-day high, but it's not closing above or not closing above upper Bollinger Band, or you will put and not all these things, right? So just to avoid those three, four. And that's when, like, when you are going to that approach as a system designer, you know that you are cheating because you are like trying to avoid those three, four bad trades by putting some more condition. Like now again, you add another column, just looking at what you call it, maybe like just say 200 moving average, right? If you add, you might weed out another two, three bad rates. So now you basically are adding bunch of lines of code to weed out those bad rates. So that's you yourself know you are basically cheating with your own system designing. So that's what you are entering into curve fitting mode. So the moment you are putting more and more and statements into your code, so you are entering into that curve fitting part.
Okay.
The other way to do it, as I said, like nobody can give you an answer, right? Like how you approached it. So you said, yeah, I took 100-day moving average. So did you take 100-day moving average at the first step as a starting point, or did you try with 20, it didn't work? Did you try with 30, it didn't work? Did you try with 300, 200-day moving average, it didn't work? So now finally you settled at 100-day moving average, right?
Okay.
So the whole trial is only 4 or 5, and nobody tells you where they started and where they ended. So, like, unless otherwise you are, what is that, presented with the full facts, you don't know whether it's a cover fitting or not.
Okay.
Those facts you only know because I don't know where I started, right? So I would have started at 20-day moving average and then would have gone to 30, would have gone to 40, and then nothing worked. So I ended up at 100, but I didn't tell you this whole procedure. So that whole thing is again, so like curve fitting kind of stuff.
Okay.
Having said, I mean, the simple thing is how it is not curve fitted. Okay, so look at the first 5 years and look your strategy. Is it evenly distributed across the yearly returns? Because it's very hard to curve fit if you put that criteria. Let's say you are capturing Bank Nifty 1,000 points in last 4 years by some trading strategy, right? So that means you should get approximately about 200 plus or minus points in the last 4 years. So if it is only for 1 year, like giving like 800 points in 1 year and the rest of the years is 50, something like that. Or other ways, the number of trades also should be evenly distributed, because you take any year, generally there will be like 53% or 55% of up days and 47 or 45% of down days. I mean, if you don't do anything, that's what your statistics in any year. And if you take a 10-year period in Nifty, you only get like 2 down years and 8 up years, or like 1 down year and 4 up years. Now your strategy also should at least be in line with that. So now you have like last 5 years data. So 1 year is down or 4 years is up. Yeah, that's okay. But it's only up in 1 year and not positive another 4 years, right? So that means there's something wrong with your trading system.
Got it.
And let's say you get 50 trades, right? That means you should at least be getting 10 trades evenly across each year. So if it is getting like 40 trades in 1 year and then only 2 and 3 trades in other years, then there is something wrong with your system as well. So you see that you have like what do you call it? Even it's you won't get exactly, but you know what I'm talking, right? So
Yeah.
there's no difference between 10 right, or 10 and 12 or 8 and 9, something like that. But if you say 1 and then there is a 30 another year, the number of trades, then there is something wrong with your system. So yeah, I mean, like looking at the results also, you can say, yeah, whether this is like purely, I mean, like curve fitted or not. Yeah, by looking at those, yeah, the number of
Parameters.
trades or.
Okay. Okay. When you backtest ideas for Bank Nifty or Nifty, let's say
Hmm.
you have an idea regarding a couple of option spreads or some directional option strategy, do you usually backtest your idea with options data or do you use spot or futures data for backtesting?
You have to test on what you are trading. So if you are trading options, so you test on options data.
So, do you get access to options data?
Yeah, you do have the options data vended by Nifty. Yeah.
Which vendor do you prefer for the options data in the Indian market?
I don't know actually. So I don't know in the sense we use. I mean, at least I mean my data vendor is Bloomberg, so I get the data from Bloomberg. But there might be quite a few uh, data vendors who can do it. I mean, or anyway, NS India gives you the free data at least on a daily bar level. So your
Yeah.
daily bar is sufficient. I mean, if you want the options daily data, so NSE anyway gives you, so you download them and then you build your own options database.
Okay, got it.
Looking at a minute database, then yeah, you have to go through
Data vendor.
vendors. Then yeah, so then there is a how clean is the data. So all those things comes in. But I think yeah, so because our trades predominantly are on a little longer horizon. Also longer horizon. I mean, what I mean is like a 1 day to 5 day holding
Okay.
period. Yeah, so whatever the instrument that you are trading, you have to test on it. So if you are trading on a spot, which you cannot do because it's expensive in the sense getting in and out of from Nifty spot index, which is like you can create your own Nifty basket, whatever is the weight. And so you can trade 1 lakh worth of Nifty by putting 10% into Reliance, this, that, and or you can do a Nifty ETF. But again, there is a uh,
Mm.
whether uh, he's actually keeping the ETF versus spot again, whether the ETF guy is in line with the current Nifty weight level or not. So there's that particular doubt will come. So the whole thing is, yeah, if you want to trade spot, you test on spot. If you want to trade futures, you have to test on futures. If you're trading on options, you test on your options.
When you test on futures, do you also take into account the rollover factor? I mean, do you test on month over month data or do you somehow smoothen the data and test on continuous futures data?
There are like quite a bit of continuous contract construction methods, right?
Yeah.
So when do you roll over? So do you roll over on option expiry day or first day of option expiry or 5 days before option expiry? Because that's where people start switching into the new expiry.
Correct.
And then how do you do the adjustment? Because when you roll over, basically your Nifty futures or bank Nifty futures, generally the theoretical price is basically spot plus interest rate minus dividends. Okay, dividends are taken care of. Now spot plus interest rate, which is like 5% or 6%. So generally, your difference would be 30, not 30. About Nifty is trading at 10,000. So generally, a 50-point premium is what you get. So now, how do you adjust? Do you adjust it across the month, or do you adjust it only for that 5 days? So there are like quite a few adjustment methods. Like you can, the last time that I read and collected, there are at least about 8 to 10 various adjustment methods on a how do you build a continuous contract. The one that I prefer is I just give a weightage of uh, what do you call as a 20, 20 80 40 60 and then 60 40 and then 80 20 and then 100 0. So what it means is on the last day of the expiry, you would have completely gotten into a new price. A prior day, you would give 80% weightage to the back month contract and 20% is weightage to the front month contract because that's anyway is getting expired. Now, 5 days before, you give 80% is weightage to the front month contract because that is still active and 20% weightage to the back month future. So, your jump is not so uh, high. I mean, like on any day, if you just take a Nifty future and then just what you call as a trade either the back month or the front month and immediately exit. I mean, exit within the 1 minute, your slippage is hardly like 1 or 2 points. I mean, basically, yeah, the slippage is your bid ask spread, which is like 2 points. So you lose 2 points on front month contract and on back month contract, you may lose extra. So, I mean, I use that smoothing method when I doing the futures adjustment. Yeah. I mean, not like a 50-point jump and doing because let's say on 10th of August, like 15th, now we are on 17th of August, right?
Yeah.
So, which is like 10 days away for expiry. So, what is the interest for me to look into even back month contract because I still can exit in and out even though because I know my exit periods, right? So I won't be holding for more than 5 days. So yeah, the other methods like GAN method or uh, the ratio adjusted method or these things, right? So they don't help in this minute point because you only try to roll over when you get into closer to the expiry. Otherwise, and again your time frame, right? So my time frame is maximum 5 days. So yeah, I get into that rollover business only when I go into the last 5 days.
Okay, when it comes down to options trading at your firm, do you trade in a completely hedged manner or do you take directional trades also?
I don't believe in hedging because hedging is your cost to the business.
Correct.
So again, the hedging is what is that you are trying to hedge? You are trying to hedge because you have a fear of market going down or your trade is going against you. Yes, they do go against you. Now, let's say every month you have a fear of 10% fall in Nifty, right?
Okay.
So I don't want to lose more than 10% if I'm holding a Nifty, whatever Nifty contract, one future contract or one whole cash contract which is worth of 8 lakhs notional. If you have to hedge that, okay, if you have a fear of 10% market fall, you basically have to buy a put, and that put is your whole additional cost to the whole business. So, like once in a 10 years, you will be saved from that the big down event or whatever. But the rest of the years, it's a cost to your business, and it will eat up into your overall expectancy of the system. So I don't believe in hedging because it's a expense to your business.
So, in the different strategies that you trade, you basically use a fixed or a moving target and a proper stop loss, and you just let the trade take its course, right?
There's no stop loss again. I don't believe in stop loss. I,
Okay, any reason why you don't believe in a stop loss?
in any most of the cases, you can. There are like two things. One is at a lower uh, uh, volume or a lower capital base. Yes, you think capital stop loss is going to save you. That's on a theoretical level. But again, so the whole point is yes, you can optimize the stop loss level. That is one point. The second point is now you test your trading strategy without stop loss and with stop loss. So there won't be much difference. I mean, it's like only one or two trades which gets saved you from that stop loss level. Otherwise, there's another problem. So now as your trade size becomes bigger, now let's say today's, I don't know, what is today's Nifty futures high or low?
Nifty futures today was around 11,155 low and high was around 11,285. Yeah.
1190, right? So it so happens now, let's say uh, it's 12,160, right? So now the low point of the day is 155. Now at 155, you probably the entire number of contracts that would have traded might be like 50 or 20 or 10. I mean, it would be a very low number, right?
Okay.
Now, let's say you're holding 100 contracts. So, where do you think your stop loss is going to hit? It's not 155, it is somewhere else. Or your 10 contracts gets filled and 90 you are still holding them. So, you think just by looking at historical data, yeah, my stop loss would have triggered this, I don't know. And on top of it, the second is if uh, any, I mean, 100 lot level shown as a market order, it's not going to execute at 155. It will execute somewhere at 140 or wherever. So your stop loss, which you arrived from the historical data, is all useless because that's not the. I mean, market is not going to be so favorable to you in executing your stop losses. So that's one of the reason I don't use stop loss. Neither I advocate them.
Okay. What is your primary risk management criteria then? I mean, how do you manage your risk?
The risk is when your size becomes too high and you are not able to uh, handle. I mean, like handle in the sense, like let's say, I mean, most of the people think, okay, 2% down day, I might lose something. So, how much is your leverage? So, if your leverage is proper, like something like two is what I advocate, or maybe as your size goes bigger and bigger, you should be reducing that to one and off.
You mean 2x leverage?
I mean, like, see, a bank nifty in March 2000, it has fallen 40% in a month.
Okay.
What it means is if you're operating at 2.5x leverage, you are bust, right?
Correct. Yeah.
I mean, assume you just bought a one Nifty contract, one bank Nifty contract for fun, and you don't want to exit, and you want your holding period is 20 days, right? Which is month to month. So a 40% fall, which is basically translates to 2.5x. So if you're using 2.5x leverage, you are gone bust. So and that's simple. Even in Nifty also, there are 3 months in historical data where Nifty has fallen more than 25-30%, something like that, 25% in October
Okay.
2008, or in recent March, it has fallen like something 20%, right? So any
Hmm.
4x leverage, you are bust. So that's the reason I said like 2x is what your maximum leverage that you could employ if you're operating only on a single contract. I mean, like only single instrument. Now, if you are diversified into little bit into bonds and little bit into some other thing, then yeah, probably you might increase. But I would say, I mean, like at an overall portfolio level, anything beyond 2%, you are bound to go bust, or you are that fear of a big down day or big up day, whatever. So yeah, I would say you basically control your entire trading game via your leverage. So what is that optimal leverage? I would say 2x at a smaller trade account size, and if your account size is bigger and bigger, reduce it to 1.5x leverage or something like that.
This is at a portfolio level, right?
Yeah.
But on a per trade basis, how do you manage risk? I mean, at what point do you know that the trade has failed and that you have to get out?
Yes, sir, I don't see the whole back testing. What you have done based on a fixed time exit. Or uh, as I don't put stop loss, okay, that's fine. Okay, but now let's say you designed your system on a stop loss level, all on a fixed exit. So you wait for that. Why do you want to poke the trade in between? So you know your historical tests are giving you uh, some 20-point expectation. So how they gave you 20 point? Because your holding period is entry at time
5 days.
some time and exit at some time, or exit in between if there is a condition like a stop loss. I mean, for me, stop loss is I don't put, okay, that's fine. So now, any of these conditions met, yeah, you either stick to those conditions or exit when those things are there. So there's not nothing like you monitor each and every trade individually. I mean, that's like your micromanagement. That's where you are wasting too much of your energy into watching the screen and poking the trade and messing up the whole system and this that. So I mean, I don't do
Uh,
that as well, neither at individual trade level management. So if my exit is yeah, so entry is at close of today and exit is close of tomorrow. So you wait till through 25 because that's where your exit, right? So
okay, so you're using time based stops. So if your waiting period is like 5 days for a trade to play out based on your back test, and 5 days are over and you're still in the trade, you will exit on the sixth day, right?
yeah,
Okay, this makes sense. In your back tests, this time based stop has worked better than a fixed price stop?
it's not a time-based stop. It is based on a time-based exit. Yeah, I mean, most
Yeah.
of my entry and exits are time-based.
Okay.
It's a 98% of the time, but the 1% where you override is, let's say, by chance you are long today, and tomorrow morning
Okay.
favorable news has come, and like market jumped 1%. So you might want to take off something off the table because yeah, yeah, it's yeah you. That's like sometimes it's always a little nicer to book profits or whatever. But otherwise, yeah, I would say whatever is your system design parameters, yeah, you stick to that. So in my most of the systems, it's um, entry at certain time, exit at certain time. So it's like 1 day period, or is it 30 minutes, or is it 5 days? So you stick to that.
Okay. When you come up with a system, what are the predominant parameters you think should be used to qualify that a system is acceptable enough to trade, apart from profit expectancy? I mean.
So one is your profit factor. What it
Okay.
means is dollars you are winning for your dollars losing. So that has to be more than one, because if it is one, you are paying brokerage.
Correct.
So now is that number is 1.5 good enough or 2 is good enough? You have to, each guy has his own rationale. So now my preference there is like if your historical trades are less in number. So what do I mean by less? Anything in between 25 to 15 number of trades is a less. So there it has to be at least more than two. Now your historical rates are high, like something closer to 100 plus. Then you might be little lenient because anyway you are placing 100 trades. That means 1 in 10 days. Something like that. Like I'm comparing the last 1,000 days as my backtest period, right?
Okay.
So if your trade sample size is more, then you be little lenient on profit factor. But again, how much lenience you can be, like maybe 1.5, 1.8, something like that. Now then you basically also look at whether the whole trading strategy itself is statistically significant or not. So you use some statistical parameter. It could be a t-test and then converting that into a p-value. So basically, yeah, I emphasize that p-value. So it has to be statistically significant. Otherwise, factor also can lie to you, because just like one or two big trades here and there, and they might give you a different picture. So I look at a p-value as one of the more stringent criteria. Then you also look at what else, like is it profitable across all the years which you are testing, or at least 4 out of 5 years, and is the profit the number of points that you are making, is it evenly distributed across the years? And then there is a maximum drawdown. So now maximum drawdown is, okay, your trading system has let's say 10% returns and 20% drawdown, right? So that is like 10 by 2, which is 1 by 2 number. Now this 1 by 2 you go and compare with, instead of me doing all this gym mix, if I just gone with the buy and hold, what would have been my uh, return return divided by MDD, which is like common ratio or something like that people talk.
Okay.
Now it has to be better than buy and hold system. Otherwise, I rather just buy and hold Nifty or Bank Nifty. So you give emphasis to your comma ratio, right? And then you also could do a comparison between a sharp of your trading strategy to buy and hold. So if it has to be better than buy and hold. Otherwise, you rather buy and hold, right? So why do you want to design and break your head in designing all the system? So these are some of the parameters. So it's not only the profit expectation, yeah, but you look whether it's really the whole trading strategy itself is statistically significant or not, and comma ratio things. And then there is a drawdown recovery period, right? So each trading strategy has to go through a drawdown and come out. Whether it may come out or not, we don't know, but at least in historical backtest, we will get to know. So now that's a choice. So the choice is like a 10 ton and 20% drawdown, and your recovery time is 1 year. Now there's a second system which is 5%. Sorry, yeah, 6% returns, but 10% drawdown. But recovery time is 2 years. So now which one you prefer? So you cannot wait for 2 years, right? So even though 1 year system with a higher drawdown, it comes out better. So, and again, so this is like if you have like multiple trading strategies to compare. Now, if you don't have anything to compare, you are only comparing your individual strategy. You compare with the benchmark.
Okay, so if you have multiple strategies, you look at which one has a better drawdown to
The returns ratio.
returns ratio and which one is getting out of the drawdown faster. Based on that, you have to take a decision.
Yeah.
If you have only one strategy, you compare with the benchmark and decide, right?
That again depends on individual preference also, right? So I can say it's all numbers. I can say 30% drawdown, but there are some individuals who don't really react anything at a 30% drawdown level. But there are some individuals who react or who get panicky even at a 5% drawdown.
Correct.
So you know your own risk or your risk taking ability or risk profile or whatever you could call.
Okay, when you look at these kind of systems, how do you exactly measure the slippage that you get in real time? I mean, slippage from the bid ask spread or the regular market price slippage, how do you exactly measure it?
Yeah, so when you trade, like let's say your expectancy is 20 points, right?
Okay.
That means you are entering at 10,000 Nifty today and exiting at 10,025 or some number, right?
Yeah.
So you induce uh, within in your backtest report itself when you send your parameters. So entry today close is at 10,000 Nifty, exit is at 10,050 tomorrow. Like that is your one trade. So instead of sending entry as 10,000, you put some slippage factor. So how do you measure that slippage again? So you will have in your own historical trade. So generally it is around 1.5 point or 2 points for Nifty. So instead of entry at 10,000, you are buying. So now your entry, you make it as 10,002 and you are selling at 10,050. Now there again like 1.5 or 2 point slippage comes. So you mark your exit as instead of 10,050, you mark that as 10,048. So that's what your actual result. So you induce some slippage in our backtesting report itself and then again translate. So usually for options data, it is around, depends again on which day you are doing all this. So on expiry day, there's not much bid-ask spread. So on a prior to expiry day, generally it is somewhere between 2 to 3 points on a bank nifty.
Okay.
So you put that into your backtest report and then recalculate all the parameters.
Okay. After putting together these slippage related calculations, you decide whether the system is making enough points per trade to for it to be a worthy system to trade, right?
Yeah, correct. So if I design a system which has only 5 point expectation, right?
Hmm.
Most of your 3 leg, 4 leg, 5 leg option strategies all have only 5 or 6 point system expectation. So that is what you would be paying as a brokerage and on a
Slippage.
slippage. Yeah, the slippage is okay. The only thing is it doesn't affect you much on an expiry day because there's no slippage in during that weekly expiry day because there is enough of volume. And of course, there is a slippage. I'm not saying zero slippage, but slippage is what you call as the least bothering factor. There are so many other factors that comes into trading on that expiry day.
Correct.
And this happens only in your Nifty and Bank Nifty futures side. But if you go into US market, there's no slippage in S&P future. The slippage is only that 0.25, the least minimal tick or the lowest tick value that gets traded.
Okay. Okay. You mentioned that there is relatively lesser slippage in S&P 500 derivatives. Why do you think that's the case though? Because as you said, Bank Nifty is the most traded and most liquid instrument in the world right now. By that virtue, it should also have relatively lesser slippage, right?
Nothing. I mean, that's how the contract size was designed or whatever. So,
Okay.
like, how many Nifty contracts get traded on a bid price? Hardly like 5 times, right?
Yeah.
Whereas in US, your book depth will be always like 200 or 300 contracts this side and 200, 300 contracts on the ask side. So, yeah, I mean, that's in S&P contracts, yeah, the slippage is up to 100 contracts. You would assume there won't be much slippage. The slippage is only the bid-ask spread.
Okay. In your systems, do you also use trend following strategies as part of your strategy playbook?
No, I don't categorize like that. So all that my system, there's no trend following in the version. This that. So all that is yeah, based on your historical results. Is it performing? Does it have a positive expectancy as per your criteria? So I don't categorize either it's a trend following or mean reverting. So you basically need to have a bunch of various strategies also because this whole trend following is not working in US for the last 15 years.
Correct.
Whereas a little bit of momentum strategies are working in India.
Hmm.
Now it's turn around. So the same thing is with value and growth. So
Uh,
value was outperforming till 2000 from 2000 growth. So now again the tides can turn around. So it's not like you favor only one trading strategy and you are against the other trading strategy. You need to have a basket of multiple trading strategies like that because you never know when the this whole thing is change the game.
Got it. When you have multiple trading strategies, how do you manage the situations where two strategies come up with trades that cancel each other out?
Anyway, it's canceling each other, right? So you don't take the trade. Like even if it's a trade, like a trade, one system is telling go long, other system is telling go short. Now anyway, it goes and cancels out, so you don't take the trade. So you even if you take the trade, your net profit is only zero. And of
Correct.
course, net profit is minus brokerage, blah blah whatever. But otherwise, at a expected level, both of them will come out. Like one will come out with 100 points profit and other one will come out with a 100-point loss. So it's basically zero. So instead of that, you don't take the trade when you have a conflict in signals.
Okay, but when the time frame of the trades is different, like one of the trades says you hold it for 5 days and another trade says you hold it for 10 days, how do you manage?
That's yeah, that's like let's say trade A is telling go long now and exit after 2 days or like in a different time frame or whatever.
Okay.
And B is telling go short. So now it's a very easy answer. So you wait for one signal to fail or one signal to win, and you take the failed signal.
Okay.
The signal A would have exited signal A long. Anyway, it has come out now, right? So if it like a holding period of 1 day for signal A. Now signal B holding period of 2 days, and both of them are conflicting or whatever you could call. Now signal A, because it's a faster exit because it's exiting at 1 day. You will have the answer to the question already, right? Half the question. So do that second trade and whatever is.
Makes sense. Now, when you're trading, do you take the trades manually or have you completely automated the trading execution process?
It's a semi-automated. I would say like 90% is automated.
Okay.
1% is the discretion. So
Okay. As you said, beyond 100 lots, how important is automation? I mean, when you get to the level of 100 lots and above, without automation, can you still play the same way as the automated players?
no, you have to use a little bit of automation because you have to execute that order in a. You can't execute 100 lots buy or sell Nifty, right? Because it just uh, goes and smashes the entire book.
Correct.
So I'll just tell you what is the book close to it. Yeah, basically what I'm saying is, yeah, if you just say buy 100 Nifty contracts, you probably are inducing your own slippage is 5 to 6 points. Forget about what the market slippage is because you are going and clearing the entire book. So you have to slice that order into chunks. So that's where this automated execution comes into picture. So you don't execute all this 100 lots at one go. You give them 30 seconds time frame. So within 30 seconds, each second 100 divided by 30, which is 3 lots. So you enter 3 lots. Now, do you want to execute at market order or as a limit order? Then keep taking the inventory. Like the first second, your 3 lots won't be executed at market. I mean, everything gets executed at market price, but now if you put limit order, like in between price, right? So out of 3 contracts, only one might have executed. So the next second you add these 2 contracts. So 3 plus 2, 5 is you want to execute. Now again you may not be able to execute. So now again you execute some on market order. So that logic is what some logic like that you write and then optimize it. So instead of executing 100 lots at one go, you execute at a different time frames, like in a slow fashion.
Okay, so in a positional strategy, this wouldn't be a big deal because you won't have a big market move within that time frame, like a 1 day or a 4 hour time frame. But in an intraday trader, when an intraday trader has to trade it, say on a 5 minute or a 10 minute time frame, this would be a difficult thing to achieve, right?
Intraday, that's when it's an issue and you can't trade. On intraday, you cannot trade except on expiry days, right? On non-expiry days, you cannot trade even 50 lots on an intraday, a 5 minute bar.
Okay,
There is no depth, so that's the reason I'm not a big fan of intraday trading.
makes sense.
And on top of intraday trading, once in a year, um, what happens is it's not you who is controlling, it is some other idiot who is doing a flash order, market flash cross or some other thing, right? So you don't know what happens on that day. Suppose, what is this? What is that broker who gone bust in 2013?
30 now.
2013 or 14, one Indian broker has gone bust. So yeah, I'll tell you the example. So the whole Nifty market size on a cash market is about 20,000 crores or something like that. And in a futures market, it is about 10,000 plus or minus crores. So the whole thing, my point is, we are looking at a number somewhere in the range of 30,000 crores. And this guy has sent a 500 crore market order of Nifty cash market or something like that. That was the instant. So 500 crore, yeah, it's a big number from the outside, but from the market perspective, it's a very small number, right? So on an average day, you get about 30,000 crore volume, and 500 crore is 5 by 300, which is like very, very small number, right? Like 2% of the day's volume. And then that day, Nifty flash crashed 1,000 points.
Wow.
because it's erroneous order. So now on that erroneous order, you are doing your 50 lot business on a daily bar and I want to exit. There's no way you could have exited at your uh, desired level or whatever. So you could have paid like probably 500 points lower than even for your 50 lots. So the whole profit that you made in last 1 year, or because on a again, if you go back and look on a 5 minute bar, how much Nifty can move versus a total daily absolute. So an absolute move on a 5 day bar, 5 minute bar, it would be somewhere in the range of 10 points, whereas a absolute move on a daily bar would be 100 points. So there is a capacity limitation as well. So to deploy your money in intraday systems.
Okay, this broker who put an order for 500 crores that caused a crash of 1000 points in Nifty.
Yeah, you can read Nifty Flash Crash 2013 or 2014, whatever.
Okay,
MK, MK trading,
MK.
something like that.
Okay, got it.
This situation is what I've told you in a very, very big situation. Like this, you can keep uh, reading. So you just read Flash Crash. You will find something in US. You'll find something again in India. Reliance Fat Finger, some other Fat Finger, this Fat Finger, and there's a what do you call it? There's a one US firm, which was a market making firm. So they lost their entire profits which they made for 5 years for some small error of their own. So the whole thing is, yeah, this intraday game, yeah, it looks like easy, but from outside, uh, and there was this what you call 4 years back or 5 years back, something like that. There was a Swiss franc flash crash, basically, and currency, the Swiss franc got smashed about 30% or something like that in a 5 minute span. So the whole point is, yeah, this keeps happening, and there's no way that anybody can prevent. And my whole point is, you are at a mercy of not your system. You are at a mercy of some other idiot who is causing, and you wipe out in that particular day.
Yeah, so when you set a stop loss market order for a trade in such a market condition, your stop loss order may or may not execute, right?
Not may or may not execute. It won't be executed. It will be executed at the
Worst
worst possible
case.
point.
Okay,
Yeah.
got it. And
I mean, that's what I'm saying. On a 100 days, you think your stop loss is going to work on 80 and 90 days. Yes, it works. But on a days like this, even your intraday, you think you are in control of the system, but this whole mayhem happens in 5 minutes or 10 minutes. So you don't know what you are going to do. You cannot do anything. So you'll give back all the profits that you made in last 1 year, 2 years, or whatever in one fateful day.
okay.
And that fate could be, it's definitely not in our control. It's somebody else's mistake. So
Okay, when it comes down to options,
I don't.
do you also have strategies, deploy strategies based on option spreads also?
We do all sorts of strategies. Yes.
Okay, and the kind of strategies that you deploy, that depends on the market condition and the market regime, right?
So it's like we take each parameter and we test all the possible option trading strategies out there, and then whatever is the highest profit factor or with the least volatility. Basically, we have a ranking system, and then we prefer to trade that particular strategy on that day because that is what the market condition, and that is what various if else conditions kind of stuff that we write.
Okay, if I understand correctly, from a portfolio of strategies that you have, you will rank these strategies based on different parameters, and whichever strategy has a better profit factor or a group of strategies having better profit factors will be traded on that particular day, right?
Not better profit factor, better risk adjusted profit, which is basically we're looking at, you're not only giving importance to profit factor, you're also giving importance to other numbers like standard deviation or maximum drawdown or whatever. So you basically give weightage not only to the returns, you also give some weightage to the risk, which is either in terms of standard deviation of the trades or maximum drawdown or things like that. And then you arrive at. See, sometimes you have a 50-point expectation system with a drawdown of 1,000 points. Let's just say, I'm just giving an example.
Okay.
And then you have a system which is 25 points, so which has only 200 points drawdown in the historical. So which one you prefer? Obviously, just because 50 is a big number, I cannot go because I know that that particular system had a 1,000-point drawdown. So I
Okay.
rather pick this little safer one. So it's just like it's not only score by returns, you also give uh, some weightage, equal weightage to your risk as well. So your returns and risk, and then whichever comes on top of your trading strategies. So you pick that one.
Understood. When you score different strategies, though, what kind of parameters do you use to score these strategies?
It's basically risk and reward. So what is, the risk is nothing but uh, how your trades, their standard deviation is one measure of risk, or maximum drawdown is one measure of risk. Your returns are nothing but risk, like how much profit expectation. Okay, it
Correct.
had a 50 point. Yeah, so just a simple.
But how do you evaluate on a daily basis? You said you score the systems and decide which one to trade each day, right?
Yeah, that is what the whole automated business that you are doing, right? So that is what
Okay, okay.
setting up infrastructure to on your uh, either Excel sheets or Python or your own trading platform. So that's what your whole system design is.
You basically go through parameters like what the volatility is, what the volume is, the range, and the overall market direction and all. And you also use other parameters to decide which ones to trade on that particular day, right?
Yeah,
Okay,
correct.
got it. Okay, I have a couple of questions from Twitter followers. These questions are actually outside of trading. One of these questions actually fascinated me. You're a very calm and very well knowledgeable person in this area, but on Twitter, you are very eccentric and enigmatic to a level that most people can't even understand your tweets all that much. Where does this personality divergence come from? Like, is
It's
this
not that. So you sometimes you basically I'm typing from my head, right?
okay?
So it's not like I want to type an academic article or something like that. So sometimes, yeah, people may not understand. The
Yeah,
second thing is once you start engaging and people say, okay, you do this, you do that. And that's where I get irritated because just like I'm trying to present an idea, you pick up it is useful or not. I'm not your what you call as assistant or Google machine saying, okay, explain this. Because I mean, that learning you can do on your own. So that whole thing irritation comes sometimes. So you have to be little show off or like I'm not saying show off or aggressive or arrogant or whatever, but yeah, just basically to eliminate these kind of back and forth interactions which doesn't add value to anybody, which is time waste to both the people or other people who are involved in the discussion. So yeah, so that may be one of the reasons that I write something like that, or I try to not engage if you keep. mm, yeah, I mean, if you keep asking me, okay, do I mean I told some idea, right? Like let's say market is about 20-day moving average, blah blah. You do this, or okay, uh, if you can't test it, yeah, fine, leave it there. But instead of some guy will say no, or change that to 30 meter. Can you test it? Or I have another strategy. Can you test it? Can you help me? So this whole thing is, yeah, I mean, it's like it's going nowhere. It's nobody's benefiting from the whole exercise, right? So to avoid the, I mean, sometimes, yeah, that's what it is.
correct. I have a question of my own here. You have very vast experience with respect to options and derivatives trading.
I don't say I'm vast experience. I just have to again caution. Neither I'm experienced. I'm just learning. Yeah.
Okay, from your experience though, which approach should beginners in the market take? Should beginners even try to start with options trading? Or if they could start with options, which resources would you suggest learning options trading from?
The right answer would be like work it reverse. So why do you want to trade options? Okay, there is a risk reward profile or this. Now the second thing is, in fact, sorry, what is that? You also understand the concept of notional capital or whatever. So This is how the standard accounting happens, right? I mean, like, why does Nifty or NSE India gives a notional value as the traded figure? Because there is a reason. The reason is it's a standard reporting procedure. So now people think I bought a Nifty option, which is Nifty is trading at 11,000. So I bought a Nifty 11,000 at the money call, which is only 100 rupees. 100 into 75 is okay, 8,000 rupees. So with 8,000 rupees, I can trade. But the amount that you are trading is not 8,000 there. On a notional level, it is 10,000 into Nifty contract size, which is 75. So 8 lakhs. Right? So basically, your capital deployed there is not 8,000, it's 80 lakhs. So 8 lakhs. The same thing for selling also. Just because your broker lets you sell, if you have a Nifty a margin of a lakh or 75,000, some of the brokers will let you to sell one option contract. So now the whole point is you are not operating at 1 lakh. Your and risk of the capital is 8 lakhs. That is 1x leverage. Now you want to leverage it 2x, you do the math, right? So now the whole point is uh, if you have to trade, you have to have a sizable capital. So what is that sizable capital? Even it's reverse calculation. So now let's say the best and best of the traders can achieve 20-25% returns. I mean, the best track record is from either the Soros or somebody who has given like 25% annualized returns. Now you know that he cannot be best or whatever. So try to be half best of him, which is like, okay, try to produce 50%, 15% returns. Instead of 25, you are aiming for half. Now 15% returns is what you can generate if you were trading, right? Now, how much is your monthly expense or yearly expense? It like depends on a number. It could be a lakh if you're uh, in a smaller town, and it could be like couple of lakhs if you're in a larger city, and because the rent is high and you have something some other expenses. Then again, if you have a kid, that number goes up. Okay, fine. Anyway, so you agree on number something like a lakh is what your monthly expenses. Now, so yearly you have to make about 12 lakhs. So now translate that into 15%, or which is 8 times. So unless otherwise you have a 1 crore capital, there's no point you trading. You might as well put the whole money in your Nifty or 50 in Nifty and 50% in some bond funds. So you get an average return of 6 to 8%, like depending whatever the year it could be. Yeah, so that's a reverse answer. So unless otherwise you have a sizable capital, don't even think that you want to trade. You want to trade, especially the short-term trade. Now, when you want to get into the short-term trading, these are your various options, right? Either you trade in option trading or in futures or something like that.
Okay. For those who want to start with options trading, which resources would you suggest to learn from and become strong with fundamentals? Which authors or books would you suggest?
The whole thing is again the context that the author is approaching the problem and what he wants to tell you. So some guys may not want to tell you the whole truth. The truth in the sense they may be doing some other strategies and they cannot reveal those strategies, so they write at a high superficial. And some guys just may want to do uh, the basic. So for the basics, this options playbook is a good. So you just know what is an option and what is the definition of each option, like short straddle. So what does it involve? Or some spread you might say, okay, spread is okay, buy at something or something. But again, what I don't like is he would have written it for a different market, right? So he might say this is a bullish strategy, this is a bearish strategy, this and not. So unless otherwise you have a testing ability, I mean backtest ability on your own market or on your own instrument, then all these books again becomes useless because this is a very simple thing. The main predominantly your entire Nifty returns from 2000 to 2020 have come. If you just buy on upday and you exit on the next day, you will capture. Like Nifty was at 1000 on January 2000 and it is now at 11,000 plus or minus level. So your average gain is about 10,000 points, right?
Hmm.
So entire 10,000 points have come if you just buy on upday and sell on next day. So buying on down day and selling the next day is not a profit making proportion. Right? And the
Correct.
same thing is exactly reverse for S&P market. So now from S&P was at levels of 1000, now it is trading at 3500. So that's about 2500 point gains. And the same thing, if you buy on a down day and sell on the next day, that's where you make profit. So which is exactly the reverse rules than in India.
Mm.
So these are like two simple markets, and you think they are two stock markets and they should behave the same way, right? And whereas they behave exactly opposite. So now, yeah, so if you pick up an American author book, he would be writing if he's really trying to reveal strategies with back tests and everything, right? So if you test them in Indian market, they behave exactly opposite way. So, but yeah, but as starting point, I would say options playbook. Then there is this few of these volatility books by Von Sinclair, so that you can do. Then this Nate Schattenberg or somebody, right? So that's tries to explain some of the volatility concepts.
Okay. This is great, actually. By the way, one thing I ask people who come on the podcast is about their failures. So, along those lines, what has been your biggest failure in the markets, or what do you consider your biggest failure in the market, or even which period was the most stressful in the market, and how did you navigate that? What kind of lessons did you take away from that kind of a failure or a phase?
There's nothing. See, now I'm more or less emotionless when it comes to trading, so nothing scares me. But one of the toughest period to trade was in 2011 August. Not this any of the recent periods, because the recent periods you could have avoided if you had like little market filter or some any filters. But 2011 was a 2011 August. That was the most painful period. So one lesson from there is, uh, yeah, unless otherwise you are well equipped. Well equipped means your leverage is under control. So 2011, what happened is there was not a big update where you want to exit your positions, and it kept on going down, down, down for about 10 days in a row. That is because of your previous debt downgrade. There was a shocker,
Okay.
and whereas this coronavirus thing, right? At least you got a hint, so you might as even if you got on a wrong foot in the first few days, but you got like few big updates, and then you could have just adjusted. The same thing in 2018 December when US stock market kept going. It's not like there are enough of warnings earlier, but after 3 or 4 days of deep into the down, right? So you know that it's not working, and your signals also might be like failing. So you might want to reduce the leverage. But a brutal period was 2011 August. Even in 2008 October, you could have gotten away because they're quite a big. Because I'm long only trader, that's another stuff. So yeah, so you
So you're never short the market?
no,
Okay.
because the money is to be made on the long side, but not on the short side. Most of your
Okay.
short signals come whatever you define as a bear market before some below some moving average or below some percentage threshold from the recent highs or whatever. Right? So that's what your that's where your bearish signal starts coming. Now the whole problem with the bearish signals is on one couple of um, nasty updates will come where you see the headlines like short covering or whatever. So there's no way that you could have avoided, because if you have to take profits on the short side, you have to also participate on the short covering days. So now that gives you a bad feeling. A bad feeling in the sense market is going up for no reason or everybody is making money, but you are like caught in the wrong foot, which is short covering, right? So that gives you a bad feeling. So that's the reason I don't do long. So now I'm long. If market goes up, I also make some money. If market goes down, yes, I lose money, but at least digestible, because market is going down, I'm going down. Okay, because everybody is losing, I'm also losing. It's fine. But market going up, and I'm not making. I'm losing money. Forget about making money. That happens only to the short sellers because this short covering day is very nasty. And if you go back and look, all the short covering keeps happening in your bear market periods, which is like defined by whatever measure you take, either below a certain moving average level, below a certain thing, or below certain percentage uh, down threshold from the recent highs or whatever. I mean, basically all the big updates comes in those periods. So yeah, so there's no risk reward that is in favor for the shorting. So that's the reason I don't.
Okay, during the March April time when the market went down, you were completely out of the market. I mean, completely in cash.
Yes, in US we're complete out of the market. In India we had only our index positions on.
Okay, index long.
Yeah, we do. Uh, like let's say we have 100 rupees, so we know that we don't have edge, right? So we have to deploy some capital. So what is that capital? Again, we arrive at some optimal allocation, blah blah. But forget all that uh, math behind it. But we would have put 50% where we think we don't have edge. So that 50% or 50 of the money will be going on your Nifty indexing method. Again, what I mean by indexing is instead of buying Nifty ETF, I would have done which are closer to the Nifty index behavior, like maybe a basket of stocks, maybe a basket, basically a basket of stocks. So I would run that, but I won't be running any of my trading. I think I
Trading
have edge
strategies.
because the edge would be showing it as a failing. So you get out of all your short-term trading adventure in that period where you either the signal start crashing bearish or short or whatever. Yeah, so you completely come out market.
Right. And one particular thing actually stood out to me. You had commented that technical indicators and technical analysis don't work and that you are not a fan of them. Have you tested majority of the indicators and in your tests, have they proven to be unsuccessful?
So we have this Postat backtesting engine, right?
Yeah.
So what it does is it has about 40 plus indicators and about various combinations like we take your RSA, right? RSA above 70, RSA below 30, like that. So those combinations would be some number. So if you multiply that matrix comes to 400 odd indicators or 400 odd parameters or whatever you could call. Now that and you mix the same thing. So RSI above 70 and then you pick a second parameter which is like moving average above or below something. So now your matrix is 400 into 400. So that's about 16,000 or let's say 10,000. Whatever. Now this 10,000 library you are comparing against each and every stock and ETF in US. So they're like about 2,000 highly traded stocks in US. So now your
Mm.
matrix is 2000 into 10,000 and again various exit criteria. So we basically test about a 20 million back test every day. And then I
Okay.
try to score them like based on, okay, tell me what are the highest profit factor, risk reward, blah, blah, all this stuff. So you narrow it down from a 5 million base down to let's say you want to narrow it down, right? So you narrow it down to 100 best. Now, if you look at those 100 best, right? So all it would have shown you is a very simple, like okay, price down by 5%, this Apple stock, or something else, and it's all out of those 100 top parameters, or I mean top patterns which you think are a highest profit factor, these, that, and all everything favorable, right? 80 of them are very very simple based on this price, so either price up, price down, or how much price is down, or how much price is, or maybe 20-day high, 20-day low, except a few of the technical indicators. So sometimes this RSI comes or CMF, something like that, but MACD was never coming or your candlesticks, they never come. This is, we are testing about a 5 million back test, and that 5 million I'm cutting short to top 100, right? So in the top 100, if something is working, they should also come, right? Like a MACD, if it is working, it should come. But I've seen MACD coming
Correct.
in, like every day I run that program. So every day I keep observing. So every day I want to search for MACD. It never comes in even one in 30 days or one in 50 days. So, and this has been the same case for the last 4 years or 5 years when we build that engine and we take all that statistics and we observe them. So, and mm, yeah, so um, it's like, at least, okay, they are quantifiable, number one, but they don't behave the way that textbooks are written. And when you put stringent backtest, none of the indicators works. So you stick to simple things. Simple thing is like price up, price down, or where the market is high, like, or how big the move, which is like percentage based or whatever, range based, things like that. So the whole thing is, the simpler things works. These technical indicators, it's just a fancy, like, you have like multiple bunch of indicators, and if you put them on backtest lines, nothing comes on top.
That is actually a great insight. I have one last question. If someone wants to pursue being a fund manager or a trader as a profession, what would be your advice to them?
It depends. Like, it depends in the sense. First, you need to get a grip on the basic stats. The second thing is a, a programming language or a good understanding on how do you program. So either it could be Excel or it could be Python or whatever. Now, because you are young, so you can afford to learn Python. If not, okay, at least learn Excel and have a basic understanding of stats. And then you basically read how to backtest, which is what is the statistics, right? And then, as I said, there is tons of material on the websites. So you just observe them and you test, or you learn how to test. Uh, that would be your approach. Now, if you are like want to really get into a proper career, then you have to do either MS in finance, uh, whatever that, the CFA or various courses. Right? So, but that is because the normal mutual funds or whatever, they take those barriers. I mean, those educational background. So now, otherwise, you go and do a little advanced math or advanced physics, because that's what the favor by a top-notch hedge fund. So they prefer taking candidates from outside finance background. So I mean, like, what is the purpose that you are coming? Your purpose is to learn and trade on your own. Then you learn some statistics, and then fiddle around back test models and try to get your own creative mindset. Or if your purpose of coming into market is trying to get employed into some of these funds, then you have to follow a different path.
Makes sense. How can people get in touch with you? Are you active on Twitter DMs or would you prefer people emailing you?
You can use my email ID, which is paschat@gmail.com. I would be very responding, but
Okay.
I will try to respond if there's an intelligent conversation or something like that.
Anyway, thank you for coming on the podcast and sharing all this valuable information with us, Kora. It's been a very useful session, and I've learned a lot personally from this conversation. So, thank you once again.
Thanks, Trevor. Yeah, thanks.
Hey guys, just a quick word. I hope this session was informative to you and you found some value out of it. And if you want to be updated for the next and further upcoming episodes on this podcast or videos that I'll be putting out, uh, click on the subscribe button and share this video, share this podcast episode with your friends if you found it useful. And click on the bell icon just so that YouTube updates you and whenever the next episode or next video comes out. Okay. All right, then. You guys have a great time. Until the next episode, it's Shravan signing off.